How structurally challenged is this US bond market at the moment?
Well, I think it's very difficult for investors right now in trying to determine which direction they should go. Obviously, we have the Fed signaling that they will be raising rates. I mean, certainly we expect the rate increase in December and another 2 rate increases potentially in 2017. So investors are naturally concerned about what happens to their bond portfolios when rates go up.
Right, and so what is your forecast? Is there going to be a great rotation? Is it going to be orderly? What's going to actually happen? And maybe not, in the initial rate increase in December, should it come in December, but maybe further down the line. Mohammed Al-Arian saying 30% in cash at the moment.
Well, we're not holding that much cash by any stretch. We think that with the U.S. fixed income markets being about $37 trillion, there's a lot of opportunity for investors to find value. About half, actually less than half of the $37 trillion market actually is in the Barclays Ag or in an index. And so as a result, we find that there's a lot of value even in a rate increase marketplace today.
And that leads to the obvious question, and your underlying philosophy essentially is the fixed income markets are inefficient. Where is the value?
Well, we find the value in a couple of places. Certainly, we see that as the Fed is raising rates, we like structured securities, particularly asset-backed securities, as well as bank loans and other parts of the credit market. I mean, the Fed, even though they will be, in our view, raising rates, they're going to be doing it rather slowly. And then history would suggest that this is a good time for fixed income investors, again, away from what I would consider the traditional fixed income alternatives.
And I've got a chart here which highlights the Bloomberg Barclays Global Aggregate Credit Total Return Index. Excuse the mouthful, but please bear with me. And it goes back to January last year. Essentially, corporate bonds right now are yielding roughly 120 basis points more than government securities on average. Investor demand for company debt is compressing the difference to the narrowest in 16 months. Simple question, Anne. Do you expect that suppression to continue? How much can it suppress? How much can that premium come in?
Well, actually, yes, we do believe that that yields can continue to compress from here. Believe it or not, we have more room to run in this area. And we continue to see foreign investors moving into the U.S. markets, again, increasing demand for the supply that's currently in the marketplace.
So, Anne, I just want to let Bloomberg terminal users and viewers see your largest holding in one of your main funds, Strips. This is chart 4430 in the BTV library. This is about 5% of your fund at the moment. Why is this your largest holding? What's the value there? What do you see going forward?
Certainly. So in our portfolios, when we anticipate, as we do, the Fed increasing rates, historically, the portfolio structure that works the best is to have a substantial holding in short duration or short maturity holdings, such as asset-backed securities that are floating rate, that will increase in value, and as do bank loans, as interest rates go up and the short end in line with Fed activity. Additionally, long duration holdings or long maturity bonds such as these will also perform well as the long part of the yield curve flattens. We've seen over the last year that trend, and we expect that it will continue. Of course, nothing moves in a straight line, but we do believe that this will continue.
Alessio De Longos this morning on Bloomberg talking about bull steepening trends. That's what you see then?
Yes.
All right. So what about elsewhere? I mean, you're obviously quite domestically focused here in the US, but are there opportunities elsewhere that you're perhaps diversifying a little bit towards?
Well, certainly there are, at a $37 trillion, as I said, less than half is indexed. We find a lot of value, particularly, as I mentioned, in structured securities. We think there's about 4 ways to make money in fixed income. The traditional ways, which are to go down in credit quality or to extend maturities or duration, but also to buy structure, and to get an information premium from these other areas.
But geographically in other parts of the world? Or?
Certainly. About 20% of our holdings are non-U.S. Investments. But we get paid, some people call this a liquidity premium, but we tend to think of it more as an information premium. After all, in fixed income, it's all about getting yield into the portfolio.
So, Anne, how do you view the European credit market right now?
Well, certainly, as was mentioned today by Draghi, they are going to continue their buying program. So I think we're going to continue to see a substantial amount of appetite in that market. We tend to look to corporate credit and not sovereigns outside the U.S.
Can you just give us a country or two? For example, Brazil moving interest rates around today?
No, actually more Europe.
Mm-hmm. So you're more interested in Europe?
Yes. Now, emerging markets...
Which countries, Anne?
I'm sorry?
Which countries, which sectors?
To be specific, probably not any one individual country. We're looking for company-specific opportunities in Europe.